Gold just sent a warning signal most people will miss because this isn't a rally, it's a rupture. In a matter of days, gold didn't just rise, it erased its old price reality. $4,730 an ounce globally, 1,52,000 rupees per 10 grams in India. A 63% surge this year alone, the strongest performance since 1979. Numbers like that don't whisper, they scream. But here's the paradox. This is happening while officials are smiling at podiums and markets pretend this is normal. Silver is moving even faster, up more than 5% in a single session, past $94 globally, 3 lakh rupees per kilo in India, 70,000 rupees added in just 11 trading days. That's not demand, that's urgency. And this matters to you whether you own metals or not, because when gold reprices this violently, it's not chasing profit, it's escaping something. Now here's the part nobody is saying out loud. Assets don't behave like this unless trust is failing somewhere else. And once you see what triggered this move, you'll understand why this may not stop where people think. What actually triggered this move wasn't a mystery shock. It was a decision, and it didn't come from traders, it came from power. According to the material, the immediate catalyst was a direct threat from the United States to weaponize trade against its own allies. President Donald Trump openly floated a 200% tariff on France, with similar threats aimed at Germany and the United Kingdom, tied to disputes involving Greenland. That detail matters. Because this wasn't a distant rival, it was the core of the Western alliance. Markets didn't react to ideology, they reacted to unpredictability. When the issuer of the world's reserve currency signals that economic rules can change overnight, every fiat asset inherits a new risk premium. Gold and silver didn't move because of optimism. They moved because something that used to be assumed stable suddenly wasn't. But here's where the story widens. This wasn't an isolated tariff threat. It fits a pattern of escalating economic coercion, where trade, currency, and diplomacy blur into one tool. And once that line blurs, markets stop pricing growth and start pricing protection. So ask yourself this. If this was enough to trigger a historic price rupture, what happens when the next move lands? Here's the claim that changes how you see this move. This rally isn't being driven by enthusiasm, it's being driven by dysfunction. Inside the physical market, the system underneath the prices is starting to seize up. Refiners aren't settling payments on time. According to the material, dealers are being paid 7 to 10 days late, a clear sign of liquidity stress inside the supply chain. And then comes the detail that should make you pause. Refiners are offering to buy silver at $15 below spot price. Read that again. Screens are showing record highs, headlines are screaming breakout. Yet in the real physical market, the price to actually liquidate metal is collapsing relative to spot. That's not how a healthy market behaves. This tells us something important. Intermediaries are refusing to take inventory risk. They don't trust where prices will be tomorrow. So they widen spreads, delay payments, and quietly step back. The market looks bullish on the surface, but underneath it's tense, defensive, and brittle. Now notice what's missing. There's no official warning, no regulator stepping in, no public acknowledgement that the plumbing is under strain, and that silence matters, because when stress shows up first in settlement delays and price gaps, it usually means the real escalation hasn't hit the headlines yet. And once markets sense that kind of strain, things don't slow down. They accelerate. What started as a price move quickly turned into behavior. Not from institutions at first, but from the crowd. The material describes a surge that feels uncomfortably familiar. Dealers reporting their 4th highest week in history. Order counts up 40% in days. People liquidating retirement accounts just to get exposure to silver. Not reallocating, exiting entirely. This is where the story flips, because we've seen this pattern before, not in metals specifically, but in every late-stage market where fear replaces patience. The moment when people who never cared suddenly care deeply. Old classmates calling casual conversations turning into urgent questions about how to buy, the so-called shoe shine moment when participation spreads faster than understanding. And here's why that's dangerous. Markets can absorb professional demand. They struggle with emotional demand. When buying becomes a reflex instead of a strategy, volatility stops being an exception and becomes the baseline. What's being normalized here shouldn't feel normal. Retirement money chasing short-term safety, panic framed as prudence, speed replacing judgment. And the pressure doesn't stay contained, because once retail behavior flips like this, the stress moves outward into dealers, into logistics, into access itself, which raises the next question. What happens when demand doesn't just surge, but overwhelms the system meant to serve it? Here's the evidence that makes this impossible to ignore. As demand surged, the system didn't just strain, it started rationing. One of the largest bullion dealers in the market, APMEX, quietly changed the rules. Online orders now require a minimum purchase of $500. Buybacks require at least $10,000. Think about the contradiction. In the middle of a historic rally, sellers are telling customers they can't transact freely unless they're big enough. The poor man's gold suddenly isn't accessible to small buyers. Not because silver disappeared, but because the infrastructure around it can't keep up. This is where the story permanently changes. When retailers start gating access, it signals that minting, packaging, shipping, and staffing are overwhelmed. Volume is up 40 to 50%, and the system was never built for that speed. Notice what they didn't say. There was no announcement of shortages, no official panic, just quiet rule changes. That's how stress actually shows up. Not with alarms, but with friction, minimums, delays, barriers. And once access becomes the bottleneck instead of price, the psychology shifts again. Because now people aren't just worried about cost, they're worried about whether they'll be able to act at all. And this is where the pressure starts stacking too fast to manage. While dealers were rationing, governments were adding friction. In Washington state, a nearly 10% sales tax on bullion kicked in, and the response was immediate. Buyers didn't slow down, they fled. According to the material, customers began driving 3 to 4 hours into Oregon just to avoid the tax. Same metal, same price, completely different outcome. At the same time, volumes kept surging, 40% week over week, 50% in some product lines, dealers overwhelmed, refiners delaying payments, retail buyers panicking, policy tightening instead of stabilizing. Now watch how fast this compounds. Higher prices trigger taxes, taxes trigger capital flight concentrates demand elsewhere. That demand overwhelms the remaining system, and the system responds by rationing again. This isn't one crisis, it's several small ones colliding at once. Logistics stress, policy pressure, behavioral panic, each one manageable alone, together destabilizing. And here's the question that suddenly matters. If this continues, not for months but for weeks, where does the pressure release? Because systems under this kind of load don't gently rebalance. They snap. Now pull this out of charts and into your life, because none of this stays on trading screens. When gold and silver move like this, the impact doesn't hit investors first. It hits ordinary people. People trying to protect savings, people paid in cash while assets reprice around them. If you're holding money in a bank account, this kind of move quietly tells you something uncomfortable. Your purchasing power is changing faster than your income. When metals surge 60% in a year, it's not because they suddenly became more useful. It's because the unit they're priced in is being questioned. And you feel that indirectly. Higher costs, delayed decisions, a sense that waiting is risky. The material describes people draining retirement accounts not out of greed but out of fear. Fear of being last, fear of being locked out, fear that access, not price, will be the real problem. This isn't ideology, it's lived behavior. Driving hours to avoid taxes, accepting minimum order barriers, paying higher local premiums because supply isn't there when you need it. If this feels familiar, say so in the comments, because once enough people feel this pressure at the same time, the shift stops being personal. It becomes systemic. Here's the calm insight hiding underneath all the noise. This doesn't happen because people suddenly love gold. It happens because systems reward certain behavior when fear enters the equation. When policy becomes unpredictable, capital doesn't argue. It moves. When rules change overnight, liquidity looks for exits that don't require permission. Gold works in this environment for one reason. It has no counterparty, no signature, no promise. And that's why, according to the material, central banks doubled their buying after 2022, moving from roughly 500 tons a year to nearly 1,000 tons. Here's why that matters more than headlines. Central bank demand creates a floor. It doesn't chase spikes. It absorbs dips. That changes the entire structure of the market. Volatility stays, but collapse becomes harder. And notice the incentive loop. Governments weaponize currency and trade. Other governments respond by hoarding neutral assets. Markets observe that behavior and follow it. Retail arrives last, reacting to the signal without fully seeing the mechanism behind it. This is where the story gets unsettling. Because once a system starts protecting itself this way, it rarely goes back to trust-based pricing. It moves toward defense-first logic. And that raises the next question. If this is the foundation, where does it push prices next? From here, the path forward splits, and neither option is calm. One path assumes pressure eases, trade threats cool, geopolitical escalation pauses. In that scenario, silver especially looks exposed. The material warns that after moves this vertical, a 30 to 35% correction wouldn't be unusual. Silver has tripled from around $30 to over $90. That kind of speed stretches any market. If tension fades, volatility snaps back fast. But the second path is why markets aren't relaxing, because if uncertainty persists, not worsens, just persists, capital behavior doesn't reverse. It hardens. Western investors are only now arriving. According to the material, 2025 marks a reversal from ETF outflows to massive inflows. Over 500 tons added, C2CE 130, EB84, D048, a 4997, a 5F40. That's institutional money rotating, not panicking, and this is where momentum quietly rebuilds. Gold still represents less than 0.2% of U.S. portfolios. A fractional shift out of bonds overwhelms the metals market entirely. So the question isn't whether prices pull back, it's whether any pullback attracts sellers or just stronger buyers. And that decision may already be forming behind the scenes. Here's the insight that ties all of this together. What you're watching isn't a bubble forming, it's a reference point breaking. When gold reprices this fast, across currencies, regions, and institutions, it stops being a trade and starts becoming a signal. Not that the world is ending, but that the old assumptions aren't holding. The story was never really about gold hitting $4,700. It was about trust quietly draining out of systems that used to feel automatic. Trade rules, currency rules, access rules. Once those feel conditional, markets don't wait for confirmation. They move first, and that's why this moment matters. Not because of where prices are today, but because of what behavior they're pulling forward from tomorrow. This isn't the end of the story, it's the setup. The next phase will decide whether this resets slowly or violently, and that's what we'll be tracking next. If you want to understand where this pressure goes before it shows up on your screen, follow for the next breakdown.